All right, let's jump straight into this explainer and unpack the totally fascinating and honestly somewhat contradictory financial state of Peloton as of June 2026. Look, if you follow the connected fitness space, you already know Peloton has been on an absolute roller coaster these past few years. But the latest data, it paints a picture that's literally making Wall Street analysts do a double take. It all comes down to a really glaring paradox. How exactly does a company make more money by selling less? If you just glance at the surface metrics, it looks pretty grim. Hardware sales are dropping, and their connected fitness subscriber counts are actively shrinking by hundreds of thousands of users year over year. Yet somehow, despite all that, Wall Street is actually flashing buy signals. How in the world is that possible? Well, to shock you right out of the gate, their recent Q3 adjusted EBITDA came in at $89.4 million. That's a massive $83.6 million improvement from last year. And get this, it's their fifth consecutive quarter of positive adjusted earnings and free cash flow. Against all odds, they're actually generating cash. So here's our workout plan for today's explainer. We're breaking down the Peloton paradox, how they're shifting gears to subscriptions, the way they're slashing costs to pump profits, their massive balance sheet detox, and finally, Wall Street's ultimate verdict. All right, let's kick things off with Section 1, shifting gears to subscriptions. There's a really stark contrast playing out right now inside the company. On one hand, you have plunging connected fitness deliveries. Hardware sales are down a painful 27% year over year. Ouch, right? But on the other hand, there's this deeply resilient, stabilizing focus on their subscription base. They aren't just a bike-selling company anymore. They've effectively morphed into a subscriber retention company. When you break down their Q3 revenue, the numbers speak for themselves. Hardware brought in just over $205 million. But subscriptions? They generated more than double that at $418.5 million. Subscriptions now make up a whopping 67% of their entire revenue mix. This transition away from relying on those one-off bike sales is really the bedrock of their newfound financial endurance. And to offset all that hardware fatigue, they're actively expanding the ecosystem to tap into high-margin revenue streams. For instance, they recently acquired Scope, that's a connected Pilates reformer technology, which is a huge, bold bet on a totally new demographic. They're also licensing out their massive content library to a major music streaming platform. And, this is quite clever, they introduced activation fees for used equipment. So now, they're monetizing a bike even if you buy it secondhand off a neighbor. But you can't just change what you sell. You have to radically change how you spend. Which brings us to Section 2, slashing costs and pumping profits. Peloton is aggressively bleeding less cash simply by trimming the fat across the entire board. Total operating expenses are down 23%. They took a hatchet to advertising and marketing, slashing those budgets by an incredible 46% year over year. Yet hardware revenues only fell 27%. Which proves they can actually acquire customers way more efficiently now. Throw in a 22% drop in R&D, a right-sizing of their physical corporate office footprints, and eating a $21 million one-time hit in executive departure costs, and wow, the cost-saving momentum is just undeniable. And all this severe cost-cutting is definitely working. The profitability metrics are showing huge year-over-year improvements. Total gross margins surged by 780 basis points, hitting 51%. Operating margin flipped from a negative 5.2% last year all the way to a positive 8.3%. And their free cash flow margin? It's sitting strong at almost 24%. It's business 101, really. By spending less, they're keeping vastly more of every single dollar that walks through the door. This isn't some happy accident either. It's a highly deliberate survival strategy. CEO Peter Stern recently made it crystal clear, stating they delivered their fifth consecutive quarter of positive adjusted EBITDA and free cash flow directly due to improving hardware unit economics and right-sizing the overall cost structure. So Peloton is prioritizing unit economics over reckless growth. Survive first, thrive second. Building on that exact momentum, let's look at Section 3, balance sheet detox. 35%. That is the massive chunk they've managed to shave off their net debt year over year. In a very short amount of time, they wiped over $311 million completely off their net debt ledger. At the same time, their unrestricted cash and equivalents actually grew by over $85 million just quarter over quarter, sitting at a very healthy $914.3 million. And because total debt is down 11.3%, that net debt figure plummeted to just under $585 million. Listen, deleveraging a business at this speed is huge. It completely de-risks the company and gives them that vital liquidity they need to renegotiate debt or maybe even pursue some smart M&A down the line. So, what does the financial sector make of all this? Let's check out Section 4, Wall Street's Verdict. There's some serious optimism hidden just beneath the surface here. Even with some quantitative systems flagging market underperformance, the wider analyst consensus for the next 12 months is actually a resounding buy. With shares hovering around the $5.77 mark, the average Wall Street price target sits at $7.75. That is offering over a 34% upside. And the highest mitts, they're reaching all the way up to $11. But to be perfectly impartial, we have to look at both sides of the coin. The bulls, well, they absolutely love the new financial flexibility, the incredibly disciplined cost-cutting, the scope acquisition, and of course, those higher profit margins. But the bears definitely have valid concerns. They point to weak historical sales growth, the fact that total subscribers are still declining, the real risk of cannibalization, and let's not forget the recent massive recalls on seat posts, which is a genuine threat to brand trust. So, it all begs the question, will this major pivot to a subscription-first model be enough to secure Peloton's long-term endurance? Or will hardware fatigue eventually catch up to them? I'm going to leave you with that final thought to ponder as we watch this corporate survival story unfold. They've certainly proven they can stop the bleeding and find profitability with a smaller footprint. But honestly, can a connected fitness company survive forever if the actual connected hardware stops selling? It's a wildly fascinating case study in turnaround strategy, and it's definitely one we'll be watching closely.